Ta-da, ta-da. Welcome everybody, episode 7, what we're doing. Normally it won't be this late. The Rams were playing, so I had to watch the game because we're doing pretty bad. But nonetheless, we're here. Let's talk about the markets. The markets, they did an all-time high. They were all at an all-time high. Basically because on Thursday, we ended up getting the good old boy, Cutlow, coming out saying that the market, that they were close to a deal, that they were close to a deal and that they were going to sign it. Same thing, same exact thing, nothing new. We already know this. He already said it before. But it set up the market for a great spot. Plus what Paul spoke about in Congress, so it gave everybody confidence. Basically, the Fed has the bag, don't fight the Fed. Everything that we need to know, and we already know. Same thing. So, of course, the market was ready to rally. And being that the market, the Dow was near it, the 2,800 mark, it was going to get there. It was all pretty well set up. Now, with the Dow at record highs at 2,800, S&P at 3,120, NASDAQ at 8,300. What is there left to do? What more can they do? It could rally higher, but some of the data that I have, we're going to touch on it. Basically, the consumer data, consumer confidence fell 08 low. The big drop, the drop was, like the 808, the 08 low. That's what that means. The mixed bag that we got in CPI, PPI. Right now, the futures are, they're flat. Right now, as of now, they're flat. Nothing special. But let's go ahead. So I brought up the PPI, right? That was a play. Gold was said that it was going to touch 1448. It clipped 1449. We didn't go above 1480. We didn't stay there. We got there, but we didn't stay there. Right now, we're back up to what are we at? I saw right now. Sorry. You know what? Might be easier to click on it. 1466. That's what we were at. 5-day chart. Let's quickly. Oh yeah, we never got to it. So we never got to 1480, and that's something that I want to bring up. If we don't get to 1480 and hold it, we're gonna come down lower than 1449. One of the reasons that 1448 call was interesting to a lot of people was because we kept hitting 1510. But we could never get it back above 1530, which is a massive key level. It's a huge key level. A bunch of resistance up there. But we kept nicking it. The 1510, 1511, but we could never go above that or hold 1520 for long. We will always come down and test this level 1466, 1460, that level, we will hold it. And then when we can't beat that resistance, and we're not rallying on good news, meaning, with the Fed and everything that they're doing and markets are selling off. So it was gonna come down. You can't rally on good news. You're not gonna do much. It's just you're bound to come down. So that's my concern. That's something I want to bring up. Again, if we stay at this 1456 level, and we can go back to 1480, I think we're gonna be positioned to go down lower. To keep that in mind, all you have to do is buy some puts. If we don't hold this level, you don't need to buy too much. You're gonna go in it. Probably test 1410, probably 1,400 maybe around there, but 1410 will be the level I'm looking at. Because if we can't hold it, it'll just do another big drop. Market's still rallying. On the same news, who knows, they might send a deal soon and then we'll all get back to normal. And then, they'll process the data that came in because phase 1, deal, we're near it. We're going to sign it. It's imminent. So the core CPI, all of them came out so-so. It went up a little bit. Now, we know CPI is, we can see it. We feel it, bring it up. When I was a little kid, 2001, 2002, a bag of chips would cost you $1. Now it's like 180, 189. I was shocked, and because I don't really pay attention to it. And the prices, the little right-hand corner side, I really don't look at it until I did. I'm like, holy smokes, I thought they were 149 when I was in high school. Not that long ago. Like, what, 8, 9 years? So the CPI, month over month, it was up 0.4, 1.1, 1.8. Chairman, the Atlanta Fed also, revised this thing down to its lowest thing to like 0.4. So GDP growth. That's the Cleveland one. That's why I brought it up. So that's Wednesday. Thursday, we got the other ones. Oh, here there. PPI up 1.6. Core PPI up 0.3. Jobless claim was up a little bit higher. There is companies laying people off, so it's bound to hit up higher. This is with the 3 rate cuts. And it's gonna take effect. They're waiting on the 3rd rate cut that they did to see how the inflation's gonna come up. That's the whole 9 things, the whole 9 yards. It hasn't hit yet. According to these numbers, it hasn't hit. I mean, it's barely touching anything. Jobless claims, PPI over month, again, up. Thing about the CPI and the PPI, it doesn't measure prices, price assets, right? Asset prices, sorry. Meaning that they're like, where's all this inflation at, right? Where's the inflation? Where's the inflation? Where's the inflation? Where's the inflation? That's what you hear all the time. We keep hitting highs. As long as inflation keeps going lower, according to them, the more, and they keep cutting, money's cheap, companies are going to do buybacks. Well, stock prices are going to go up higher. PEs are going to go up higher. The multiples on everything is going to go up higher. Why? Because money's cheap. They can just continue buying, continue doing what they're doing. And it's simple. Why not? So where is all this? In the houses. Anything that's an asset is there. You just don't see it. I mean, you don't feel it unless, you're buying small stuff. Bubblegum, all these little things, it is going up higher, but so again, they're not too concerned about that. That was the last. The retail sales. Okay, core retail was down. I already have those up here for you guys. Not much, but it was down. If you look at the chart, with the 2 years, we haven't had that big drop yet. We haven't had a big drop coming in here. You do 5 years, you see it. There's always these little drops, but we haven't had it yet. On the year chart, only that one, but it doesn't really count. Right? So it was down. Previous was negative 0.1%. The reason I'm bringing this up is because, where are you at? Okay, so this is a consumer confidence chart. This is a drop that they bring up. It dropped. We're at the low at the levels that we were from the drop from 08, and we were at peak. People kept buying, using credit cards, using all these things that they were, all these nice things that we're buying. The other thing I wanted to touch on was off of this was consumer delinquency. And something that has been coming up more and more, right? Rise in auto loan delinquency moderates as banks focus on credit quality. Here's the thing. You're allowed to buy a car, right? You buy a car, your first car, $10,000, $15,000, depending on your credit, whatever is credit worthiness. And they give you the interest rate. Back then, you would just pay it off and you move on to another car. What they do now is, a rolling bank loan occurs no loss. So what they do is they'll let you get a newer car. Once you pay off, you have equity in your car, and they'll put that negative equity on top of your new car that you want, and then you pay, $27,000. I think this man paid. For $45,000 for his car, for a Jeep. $27,000 what the car is worth with the loan and everything he got. It was $45,000 because he kept putting his equity in it. And I know a bunch of people that are doing this. It's gonna end bad. It's subprime mortgage, subprime auto loans. It's gonna end badly with all this stuff that's going on. The other thing that I wanted to bring up was that, right, consumer confidence, consumer credit change. They were expecting 18%. They were expecting 17.8 billion. We ended up only getting 9.5 billion. Two things are happening in my opinion. Either people are running out of credit, or people are paying down their credit cards, or people are, getting ready for what's going to happen. Black Friday. Black Friday is coming, 2 weeks. 2 weeks, I believe. So with Black Friday around the corner, are they saving up their credit? Did they pay down their credit to then hammer it out? That's what attracted my attention. It's like, if we're right about the fundamentals being wrong or goofy, it makes sense for this to eventually to trend downwards and then be completely shut out. 5-year chart, there's a drop. 10-year chart, we've been pretty well good. I mean, you don't see these that were back in the crisis, in the Great Recession. So we're due. Being that companies had to export everything before September to avoid the tariffs that Trump was supposedly going to put, and then he, pushed back a little because he wanted to show gratitude to China for his thing, not mine, because of the 70th anniversary of the Communist Party. Because they asked him, so he did it. That's his stuff. That's what he said. But he also brought up that the consumers were going to feel the tariffs. So he pushed them back to December, the last round that China wants to get them off or reduced. So this is something I'm keeping an eye on. Because, you have these low moments, but then it pops up. So I want to see if it pops back up. Obviously, we'll find out with Black Friday because that's the biggest, shopping time for us. They had to bring in, the companies had to bring, the point I was trying to make, the companies had to bring in their stuff earlier. So consumer exports, imports, we're doing better on the export. I mean, the imports and export, ratio because the tariffs. They were supposed to bring back the jobs. There was something else I was bringing up. Oh, next week's. What's going to happen tomorrow? Oh, the housing permits, PPI in Russia, housing permits in the U.S., manufacturing sales. They're expected to be down. So, that's Canada. Sorry. There was one more. That was 3. Darn it. No, I guess it's just this one. The building permits. Hold on. Oh, next week. That's what I'm trying to do. Oh, so sorry. Oh, the GDP index, right? 2.4. They expected that to be up. That'll be on Wednesday. This is all on Wednesday. Durable good orders, core PCE. So again, if gold doesn't hold up its thing, we're gonna come down, or we're gonna come down hard. But we're still gonna be able to 1350 level, which is when gold finally broke out and was in this bull market. And up until right now, we're just holding it. So Wednesday will be a good day. We'll find out if gold holds it or we decline all the way down. Which if it can't hold it, I'm telling you, we don't go to 1480 and hold, and then work our way back to 1500. We're gonna get hit. The ratio on gold and silver is also extending back up to we're in the 80s. But it's looking like we're gonna go back to 85, 86. Basically, use it divide the ratio, the price of gold into, or the price of gold, silver into gold. Once you get your ratio. So I wanted to bring up the Paul thing. What he said to Congress about the repo market. Remember last episode we did was about the repo market crisis. I have puts on Walgreens basically because I don't think they're gonna have the funding. They're gonna get the credit in the market, the bond market, because it's gonna be an all-out loan, 55 billion loan, and with the repo market being like a, oh my god, Zoltan brought up. Yeah, I forgot the name already. Zoltan, sorry. And he brought it up that it's gonna be hard for these banks because they have to pass their stress test at the end of the year end. So they already know what they can do and can't do. They can't enter day trade because you don't want to be the first one doing it. He brings that up because then everybody knows that you're not gonna pass the stress test, so it puts you in a pickle. So nobody, whatever bank is needs help, is might get crushed in the bond market. So that's the play on the Walgreens thing. We're going to listen to him. We're going to talk about it a little bit. It's a short clip. It's from Bloomberg. Can't read the article. I can't read the article all the way because I got to pay. You gotta be kidding me.
Historically speaking, is the Federal Reserve positioned as well as it has been positioned in past recessions when the Federal Reserve was the primary go-to agency where the federal government said, we need help from you to stimulate the economy. Are we positioned there, or are we out of position?
Well, if you look at post-war, typical post-war recessions, where what the Fed has done is it's cut interest rates, and on average, the amount of those cuts has been 5% or so. So with the federal funds rate having peaked at about 2.4% and now being at about a little above 1.5%, we don't have that kind of room, and there are a couple of reasons for that. Just you look at the longer-term interest rates, which are not directly affected much by our policy. They've just been declining for 40 years now, and that is because of inflation being lower and under control and less volatile. And also just the aging demographics means higher saving, means more savings relative to investment, and that puts downward pressure on interest rates. So
something I want to bring up. The boomers, baby boomers, they're not spending their money. They're not going to spend their money. We're getting older. I think I saw that 50% of the people of the U.S. Are now older than the minority, the younger demographic, actually, I should say, because we're not having kids. Millennials are not having as many kids, as before. So we're not gonna be able to keep up with the boomers as they, get older, retire. That is putting some serious downward pressure. As for the interest rates, I believe they're gonna go up higher. Once again, there's gonna be an inflationary recession. It's gonna come and bite us back in the butt. He clearly, he's worried. He says out there that we don't have the we kind of basically says that we don't have the ammunition, and explaining why they did what they did. But we already know he doesn't have the ammunition for the next recession. So quote unquote, isn't being a little
I think
recession.
the new normal now is lower interest rates, lower inflation, probably lower growth, and you're seeing that all over the world, not just in the United States. You're seeing it to a much greater extent in many parts of the world than we're seeing.
I hate that part. The new normal. Things always come back to the basics. They always do. I don't care what people say about the balance sheet. That's not normal. If it keeps increasing, that's not normal. It's growing at a faster rate than QE1, QE2, QE3. Now QE is growing faster. And part to do with that is the repo thing that they're doing. The repo operations that they're adding 270 billion or higher than something billion still in the repo market.
Thinking here. So knowing that, that is one of the main reasons we have, really the basic reason why we are having this public review of our monetary policy framework to see if there are ways we can alter our strategies, our tools, and our communications in ways that would make us more effective in this world where we're too closer than we would like to zero when we kind of run out of options. So that's one thing. Fiscal policy will also be important, though. I mean, I think from the standpoint of monetary policy, we're looking hard at ways to make sure that we can use our tools even after rates go to zero. Ultimately, fiscal policy has been a key part of the countercyclical reaction as well, though.
No, I do not want to hear you. But yeah, you guys could check out the article. They give you a free, because I keep using them. So I lost access, so I gotta wait a while before I could read the whole damn thing. But Bank of America has brought up this concern too. Year repo, and then they bring up the year-end repo rates are high even after the Fed chairman comments. The repo market already knows there's gonna have issues, or the banks that that are in there already know that there's banks out there that are gonna have issues. So you want to borrow a margin, it's gonna be higher. So year end, I'm keeping an eye on that. Now going into the Fed meeting, it was on the 10th and 11th. I forgot to bring it up like 2 episodes ago, but it's December 10th and 11th. That's where they're gonna meet. And you guys, if you want to keep track of the, what the market wants to do, what the market expects, because so far they've been doing everything in the market. I'm bringing this up now because just so you guys can see, as of now, current level, they're expecting a hike. And I mean, they're not expecting a hike. Okay, they're expecting to hold, right? 97.6% expected to hold. Not gonna have it, but it's interesting to me to see that there's 2.2% that there's a hike. Yeah, right. I highly doubt that. But that's something you guys wanted to see right here. CME Group. They have it here, you know, and they'll give you a rate go up and down. But right now, think about this. The rate cut is 0. So this is going to affect, again, it's going to affect gold. Not so really, not so really? Can't say the word. But I'm sure you understand I'm trying to say the word. But it won't affect it drastically because the data that's going to come in on Wednesday will show us if the gold is going to hold 1480 and move to 1480 and hold and push to 15. And if you were to buy it at 1480, try and look to get out of it 1480, some of it, half your position. That's what I'm looking to do. And if it doesn't hold, then get ready. It's going to come down. But overall, you know, when you keep an eye on the market, if the data comes out negative, I guarantee this will probably be over here at the other end at the cut. Not at the other end of rising. I should probably close this one. Okay. Oh, the other thing I wanted to quickly bring up too was I brought it up, but it's a Warren Buffett indicator. There we go. Sorry about that. Hello there. Okay, so this was brought up 2 weeks ago. I just tried to bring it up, or a week ago actually. So this is, imagine this, it's way higher now. So he's holding up to a lot of cash, and that's why people bring it up. He's holding up to record numbers of cash. He's not using it, and then came out that he sold his Apple shares, not all of it, but some of it. And he's just holding on to a lot of cash, record cash. And his indicator, is extremely high. So everyone's saying that's why he's not doing it, which makes perfect sense. So he's expecting something to come down. Everyone is. He's not the only one. So if Buffett, believes in his indicator once it's at these levels, he doesn't do it. He won't do it. Something's up. So this is even higher now because of the record-breaking numbers. So, I mean, they're all just screaming red. Everybody knows it's screaming red. And that's the thing, as the Fed cuts, asset prices, I mean, they go up higher. Stocks go up higher. So don't fight the Fed. Just keep buying. That's what everyone keeps doing. But a correction is going to happen. And I think it's going to happen in December because of everything that's going on with the repo thing. So it's going to happen. It's going to get pulled. So all these charts are just Buffett's thing, Buffett's indicator. It's basically the GDP. Market cap to GDP is a long-term valuation indicator that has become popular in recent years, thanks to Warren Buffett. It's probably the best single measure of where valuation stands at any given moment. Okay, that's his. That's something he brought up in 2001 in Forbes magazine. And it's at its high, it's at this peak where it's just current reading is 44.7 up from 142.1 the previous quarter. Quarter to quarter is just piling on. And keep that in mind. That's what the ACP earnings rate. This is from FactSet going down from 5.5. It just keeps coming down and eventually gonna go negative. The next quarter might be in the red. Fourth quarter might be in the red. Expectations come down lower. Stocks beat it. Voila, prices go up higher for stocks. So they wanted to bring up too was that, I mean, they're beating it because it's so low. If you don't beat it, you're gonna get killed. Hence, all the cannabis stocks have been one of the tragic ones. Retail sales, Russell, last time I brought it up, it's still not up. Because it's moving up, but it's still not at the highs or record-breaking highs. Hasn't set any. Da-na-na. JP Morgan, you know. This is Zero Hedge. They have these. Government, 30 trillion. Okay, that should be enough. And then there was one tweet that he brought up. No, it's a little lower. They brought up. Sorry, there's a group of people. Oh, this one. The Fed, ECB, PBOC, and BOJ all grew their balance sheets in dollar terms in October. Bank of Japan, Europe, the U.S., all of us are growing our balance sheet. So that's a new normal, according to Powell. But like I said, I believe in the basics. It's gonna come back. It's gonna bite them. Everything's gonna come back to what it's supposed to be, what we all know. Just a red. So I'm gonna keep this stream short. This is going on around the world. This is the last thing I wanted to touch on was the riots that are happening in Hong Kong. Probably hear something about it on Bloomberg tomorrow. It's getting worse. It's getting way worse. China eventually has to come in. If China comes in, goes in, the phase 1 deals. It's gonna be done. Senate is supposed to vote on showing support to the protesters. It's gonna piss off China, of course. Sending their army to clean up, and they were wearing shorts. It's getting worse, and basically, if the U.S. goes in, if China army goes in, or China goes in general, we're not gonna have a phase 1 deal. So all this rallying, all these things that keep making the market move up higher, could go sideways if they go in here in Hong Kong. It's believed that the Chinese want the Hong Kong dollar. So it'll be something. This is something to keep an eye on because it could blow up tomorrow. Literally tomorrow in the morning, you could all be hearing about it. Futures could take a drastic hit down lower, and gold could come up higher if all this stuff occurs. But again, I'm playing gold for the upside. I'm interested. I'm anxious to see what happens on Wednesday. But that's the latest news that I'm keeping an eye on because of that. The U.S. goes in, it could have drastic effects, change the outcome of everything. Some crazy videos coming on from that. All right, guys. So shorter the game, something simple, easier. Have any questions? Message me on here. You could do Whispers. You could do Instagram. Lost_still lost. Twitter, Sky's Affiliation. YouTube, you could do a comment, subscribe, ring the bell. I'll appreciate that. And on Twitch, just give me a follow. That's really all I really ask now. I appreciate your guys' time. I know it's easier, simpler. Right now, smaller stream. I just want to keep, seeing if I could change everything up. Like I'm thinking about doing 10-minute segments or breaking down. Not the stream. In the stream, you're going to get the whole probably hour. That's what I'm looking at, hour. But breaking it down to YouTube in sections. So each, we're going to have like around 10 to 15 minutes of a nice clean rundown. Or then we're going to transition into one and another. Till we get a good flow. Because still practicing, still getting, working out kinks. I'm trying to find a video producer, an editor. All right, guys, thank you for hanging out. Shorter stream than usual. Probably won't be like this. But just remember, you don't have to be the smartest person in the room. You just have to be the best listener. Thank you for hanging out. Appreciate it. Go Rams. See you guys next time. Bye-bye.